Good afternoon, everyone. Welcome to the first of this year's webinar series, Insurance by the Numbers. Today's presentation will last about 50 minutes and will allow time for Q&A. You can ask those questions as we go through the webinar along the way. Just type them on your screen and we'll be sure to get to them as quickly as we can. Today's webinar is being recorded and it will be posted to our website within a week. About the CFP-CE credits, if you are logged into the webinar today for more than 50 minutes using the email address you registered with, we'll report your attendance to the CFP board. That process can take up to a month. This year, as I said, our webinars will focus on the numbers of insurance, with this month's number being 0, which is the amount your clients should pay for unnecessary riders. We'll also give you some other ways your clients can save money. Your presenter today is Mark Maurer, LLIS President and CEO, a CFP and an MBA who constantly monitors the insurance and financial services industries. He's a member of the National Association of Insurance and Financial Advisors and a frequent speaker for NAPFA, ACA, Garrett Planning Network, and other organizations seeking insurance-related education. And now to introduce someone who certainly knows 0 in my book, Mark Maurer, for 0, the amount your client should pay for unnecessary riders.
Thanks, Dina. Actually, what I heard was someone who knows 0. So not who is knows 0. I heard knows 0. But hopefully after the next 50 minutes, you'll hopefully think that I don't know 0. So today we wanted to talk about, as we start our annual webinar series, we wanted to start with insurance by the numbers. And today we're starting with the number 0. And this is the amount your client should pay for unnecessary riders and other ways to save your client's money. What are we going to discuss today? We're going to talk about some of the riders that many times your clients are shown on policies, and do they really make sense. We're going to talk about how getting accurate quotes can save your clients money, and how the underwriting and pre-underwriting process can also save money. Policy reviews, reviewing your client's old policies. Do they fit? Do they make sense? Are there better options out there, and how that can also put some more zeros in your client's bank account. We're going to talk about universal life and annuity policies. There are no-load or low-load designed permanent life insurance policies and annuities that have lower compensation, so they create better policies for your client. Long-term care and disability insurance, there aren't any no-load, like term, there aren't any no-load or low-load term long-term care or disability policies. So how do you work within those policies to find the best policy for your clients? So first, we're going to talk about the different riders that many times you'll see on policies when your clients come to you with, especially a life insurance policy, the waiver of premium. A few years ago, I did an article called, "Would you like fries with that?" And the waiver of premium seems to be the fries, or the for buying a new car, the undercoating that always seems to be thrown onto a life insurance policy. And at the heart of it, it sounds pretty good. If you become disabled, then the life insurance premiums are waived. And again, that sounds good. Like fries usually sound good to me. But when you get under the hood and start looking at what most waiver of premium riders are and what they cost and what the definitions are, they may not be the greatest deal. And so the waiver of premium on a term policy usually has a relatively restrictive definition. It's not the UROC or ONOC definition. Usually it's an any occupation definition. Some even have a similar definition that of Social Security disability, which, as many of you know, that's pretty hard to qualify for. And it'll only cover a total disability, where many times your client may have a residual disability, may be able to work part-time because of cancer treatments or whatever it might be. The waiver premium on a term policy isn't going to kick in. And so we typically don't recommend this rider, as you could probably imagine. Well, let me show you why. Even if you don't just want to take my word for it, let me put it to you in dollars. So Sam has a $2 million 30-year term policy, and he's paying $1,700. To add the waiver of premium rider, his annual premium would be a total of $1,820. So he's paying $120 per year to cover a $1,700 expense. So I'm paying an extra $120 a year, and if I pay that, then it's waiving my $1,700 expense. So let's relay that to a $1 of the waiver of premium rider is covering $14.17 of insurance. Call it disability insurance, if you will. But if he's really that concerned, then the client should consider disability coverage. Our same Sam can buy a standalone disability policy with a 90-day elimination period, benefits to age 65, a residual rider covering, again, like I mentioned, so it covers the residual disability, not just a complete and total disability. And his annual benefit would be $50,400. His annual premium is almost $880 per year. So a much larger annual benefit, but also a much larger annual premium. So let's relate it to what $1 purchases. The $1 of the disability premium gives him $57 of insurance. If he becomes disabled, that $1 is putting $57 in his pocket. The waiver of premium rider, giving him $14.17, as I showed you earlier. So it's only 25%, meaning it is 75% less efficient than a standalone disability policy. And because many of your younger clients, especially when they're 28, 32, you're 4 times as likely to become disabled than to die before you reach retirement age. Disability policy probably should be number 1 for your client's financial plan, along with the life insurance. Now we're going to jump gears from Sam, who's young and looking to waiver of premium, adding the waiver of premium rider on a term policy, and we're going to look at Dean and Patricia, who want to purchase long-term care insurance, but they want to make sure that they get their money back. And so, you know what? There's a way to do that. And so they were shown the return of premium rider that they can add onto their long-term care policy. So for Dean and Patricia, their annual payment or annual premium for a standalone long-term care policy was going to be $3,112 per year. But they could add the return of premium rider on, and their annual premium was going to be $3,783 each year. So what's the difference? $771, or an additional 26% each year to add the return of premium rider. Now, on long-term care insurance, the return of premium rider may do just that. And some of the return of premium riders, a number of companies into long-term care, some of the long-term care revisions that companies have had in the last few years, like removing the lifetime benefits and some of those other things. Some of the return of premium benefits have either been shortened, or some companies have gotten away with it or of it altogether. But most commonly, the long-term care return of premium rider says in order for there to be a return of premium, there can't be any claims for 10 years. You have to hold the policy for at least 10 years. The return of premium would be reduced by any claim paid after that 10-year period. So if somebody dies within the first 10 years, even if there were no claims paid, there wouldn't be a return of premium. And if somebody used $4,000 of claim and they paid in $44,000 and then were qualified under this, they would actually get $40,000 back. So of course, being an insurance person, I look at this and say, is there a better way? Because what are we really doing here? We have our long-term care policy that does what it's supposed to do, provide for long-term care insurance. So basically, we're paying extra so that there's something there when somebody dies. And when you take that into its simplest form, what is that? That's life insurance. So let's take Dean and Patricia. They're 51 and 45. They're in good health. So their concern is we want to understand that long-term care insurance is something we need to look at, but we want to make sure that if we don't use the policy, then we can leave something to our kids. So we worked backwards. Instead of trying to do it all in a long-term care policy, we looked at the option, well, what would $771 purchase on a guaranteed survivorship UL policy? Let me explain what that is. A survivorship UL policy is a universal life, so that's a permanent life insurance policy that pays at a second death. And because in this case we're not worried about Dean or Patricia wanting to make sure they leave each other something, they want to make sure that in the overall plan that if they have this long-term care that doesn't reduce assets, it's protecting them from reducing assets in life to go to their kids. And at the same time, they want to make sure that the premiums, in this case, they can, they're willing to pay a little bit more to make sure their kids get something back from when they're paying out the premiums. So the guaranteed is a no-lapse guarantee survivorship universal life policy that says this policy is guaranteed not to lapse before age 100 if they pay the $771 each year on time. And that purchases $131,450 of second-to-die life insurance. So let's take a look at this. Dean and Patricia are 51 and 45. They're in good health, and unfortunately, they both die in a car crash in 6 years. If they'd had the long-term care insurance policy with the return of premium, they would have paid the $3,783 for 5 years. But because they didn't hold the policies for 10 years, nothing would go to their heirs. Had they split it out, they still would have paid $18,915 per year. Now, on the left-hand side, it's all in one policy, the long-term care insurance plus the return of premium rider. On the right-hand side, it's the long-term care policy without the return of premium rider and the $771 for the survivorship policy. So they paid in the same amount of premiums in both cases. But in my option, then their heirs have $131,450 that goes to them because Dean and Patricia are deceased. So obviously, since this is my webinar, I'm probably going to stack the deck a little bit in my favor on when this looks good. But I think there's a realistic scenario that it's possible that they might not make the 10 years. Okay, so you're saying, Mark, well, that's sort of an extreme example. Okay, let's go out 30 years. They pass away in 30 years. They've paid the policy. They've paid the long-term care insurance premium with the return of premium for 30 years. And they'll have paid in $113,000, $113,490. They both pass away, and their heirs get 100% return of the premium, $113,490. Okay? But surprise, surprise, I still win. Actually, any of you who listen to my webinars probably aren't surprised that I win. They still paid in the same number of premiums, same total amount, same 30 years. But the life insurance is more efficient on passing on the assets instead of doing it internally with the long-term care policy. So it's a 16% increase in what passes to their heirs by using the standalone long-term care policy and the survivorship life insurance policy over the long-term care with the return of premium rider. Now let's use another example. They both pass away in 30 years. Dean has a heart attack and dies, but Patricia has a chronic illness, and she uses $50,000 of her long-term care benefits. Again, because remember, the return of premium is reduced by benefits paid. So in this case, they paid in $113,000, but to their heirs, it's $113,490 less the $50,000 that Patricia used for her long-term care expenses, so the heirs get to $63,000. And again, in my example, it's 107% more because they were able to use the long-term care policy for the $50,000. That did what it was supposed to do independently there was the death benefit from the survivorship policy, and that did what it was supposed to do. So many times, sort of like the having the one policy with the waiver of premium, when you add a disability policy instead of the waiver of premium, when you combine things, many times it's not the you can do things more efficiently when you split them out. So our next thing that we're going to talk about is with life insurance, more commonly term, what's the best way to save clients money? Almost every insurance company out there has a term policy. They will say all day long that it's not a commodity, that everybody's is different, but for the most part, it's sort of a commodity. So the idea of finding the right rate class and the best insurance company and rate class is going to be the big thing. Most companies have a guaranteed premium for 20 years. Most companies have a conversion period that lasts for 20 years. But if I can get preferred with one company, select with another company, and super preferred with a third company, that's where the biggest difference is going to come in. Now, probably many of your clients, before they came to you, may have tried to do some of this on their own, and so they went to a website not unlike this one to get their free quote where they answer 3 or 4 questions, and lo and behold, spits out a quote. And so in this case, we're looking at a quote for Sam Jones, and he put in his date of birth and that he doesn't use tobacco, and his height and weight's good. And you see at the top, Genworth Financial, 20-year term, $2 million for a monthly premium of $102.38, and a number of other companies. Now, these are real rates, real companies, many of the same companies we use. And as I said before, there isn't a no-load or low-load term policy out there, so the same, if American General happens to be the same and the best option for your client, American General applies for those rates in the state wherever you are, Texas, California, Florida. And so whether you get an American General term policy from low-load insurance services, the American General person down the street, somebody's great uncle, it's going to be $104.76. But let me show you the difference on maybe why you don't just want to assume that Genworth Financial is going to have the best rate for them. The devil is in the details. And so when you ask more detailed questions, you get more detailed answers, and that allows you to create much more accurate quotes for your clients and for many of you who've worked with us, thank you, and for yourselves. So we start over with Sam. He's 32. He needs $2 million of 20-year term. He goes online. He says, I'm in perfect health. Without anything to knock down a rate, here's what he's going to see. Super preferred or preferred pluses, the next best, preferred, third best, standard plus, select. So we dig a little deeper. Find out that through our term quote online, through a conversation with myself, any of our people here, that, well, you know what, he's really in good health, but he's been taking a high blood pressure medication for a few years. Okay, not a big deal, but there are a number of companies, about half, that aren't going to consider him for the super preferred rate. Okay, that's okay. We still have 4 companies that he might get their super preferred plus rate. Okay, not a big deal. And we ask a few more questions, and his build's good, and he doesn't use tobacco. But we find out that his dad died of a heart attack at age 58. Family history of heart disease and cancer are 2 big indicators that insurance companies use when applying rate classes to your clients and to yourselves. A number of companies only consider a death, an early death of cancer or heart disease before age 60. So a number of carriers will say dad could have had a heart attack at age 58 and still qualify for super preferred. But in this case, his dad died of a heart attack at age 58. So none of the companies that we work with or any that I'm aware of would offer that very best super preferred rate class. And as you see, 90% of the companies won't offer the second best rate. But in this case, Columbus Life and Prudential still would. So because we asked a few more questions, because we did that preliminary underwriting, Sam's rate class is the preferred, with the lowest premium being $104.55. Now, had he gone with just the original quote, would have applied to Genworth thinking that the premium was going to be $102 per month, would have come back rated as a standard plus, because they won't consider him for those top two rates, $130 per month. So in this case, we see about a $25 a month difference. So that's where the pre-underwriting, where the difference is in all these different companies, and what any good insurance person should be doing to make sure that your clients are and yourselves are getting the best rates out there. So the next thing I want to talk about are policy reviews. I would say probably 40 to 50% of my day is reviewing old policies that your clients have. And you know what? I really like it. It's like a puzzle every day, because I haven't yet seen one that's exactly the same as anybody else's. You know, so usually what comes to me is, you know, Mark, here's these policies a client has. Are they any good? Well, that all depends. If the client's in great shape, there may be something we can do. If the client you know, just had quadruple bypass and started smoking because he said, "Oh, what the heck," you know, probably a good idea just to keep exactly what he has and pay the premium. But always something good to review, because we want to know, can we save money? Maybe can we increase the coverage? Can we provide less volatility for a client? And in the example I'm going to show you, the answer is yes, yes, yes. So Wayne M., he's 59 in Connecticut, and he's a standard non-smoker. He has a Phoenix Whole Life policy inside of the trust. So this is an irrevocable life insurance trust. So he can't get access to the cash values. For any of you who have clients with policies inside of irrevocable life insurance trusts, once you give it away, it's gone. They don't have to put new premiums into it, but sometimes people think, oh, I'll just wrap up, I'll just surrender this policy inside this trust and get my money back. The answer is you can't do that. The trust must pay it out to the trust beneficiaries. So for the most part, people who have life insurance policies inside of ILIS still want it to be there, but sort of a side note, but most of the time this is a lot of what we do for policies inside of trusts. And this death benefit's $192,000. He has $64,000 of cash values. The annual premiums, because it's whole life, is a fixed $1,755 per year every year. And he has an annual dividend of $725. So if he switched his dividends to reduce premiums, he'd only need to pay $1,030 out of pocket this year. And based on the current dividends, he's going to need to pay premiums for about the next 18 years. It reduces every year a little bit by the dividend, because the dividend's growing a little bit, but it's about $11,500. And the death benefit is projected, not guaranteed, in 2053, his age 100, to be $241,143. So what was our solution? Remember my little graph here. We want to save money. We want to increase coverage. We want to provide less volatility. Sometimes we can do two of these. Sometimes we can do all three. Guess what? This one, we do all three. So we're going to look at a tax-free 1035 exchange of cash values in the whole life policy, to a no-lapse guarantee universal life contract. What this says is for X dollars today, insurance company A guarantees X or Y amount of death benefit for as long as the client lives. No ifs, ands, or buts. And so what are the premiums going to be? Zero. Just the 1035 exchange and no future premiums. So for Wayne out of pocket, saving $11,500. The death benefit, $258,000 guaranteed for his lifetime. So that's a 34% increase on what his current death benefit is, and still 7% more at his age 100 than what his current policy is projected to be in 2053. And volatility, none. This is based on guarantees of the insurance company, not the dividend projections of the whole life contract. So, at the end of the day, is this earth-shattering? Well, not really. I mean, we went from $258,000 from $241,000, but did we win on the three factors that were most important to the client? And the answer is, again, yes, yes, yes. So, is that something really neat that you can do for your clients? Yes, yes, yes. Oh, and the best part is that our policy review services are free for you and your clients. You'll get a write-up from us about what they have, are there good options, what to do with the policy, and it costs you and the clients $0. I have a good question from an advisor, and he asks, if you get rated once, does that reduce your ability to get a preferred rate from another carrier that you would not have been rated on if you had gone to the second company first and did good pre-underwriting ahead of time? So the question is, if I get standard with company A and then try to apply to company B, are they going to, for a preferred rate, are they going to hold that standard rate against me? And the answer is no. Each insurance company is going to evaluate a person on their own merits. So a good scenario is your client applies to insurance company A, and the other insurance person didn't do a very good job and had applied to Genworth, let's say. And because of family history, they got standard plus. You come to us, we can apply to Columbus Life and say, we have a client, they applied at Genworth and got standard plus for family history. Per your family history guidelines, this client's eligible for preferred. And if no other reason, then the client would qualify for preferred. So they'll evaluate on their own merit. So just because someone is rated or for another policy, it doesn't automatically not allow them to get the best option that we had originally. I have another advisor's question. If we encounter clients with policies that already include riders such as these, is it possible for them to cancel the riders, or do the riders persist once the policy is in place? Almost every rider is just that, a rider or something additional to the base policy. So for the most part, should be able to delete that rider off of a policy or cancel it, unless for some reason it's truly a sort of an inherent part of the policy. It's a good question. So the next part we're going to talk about is universal life insurance. Again, I talked about the low load advantage. We worked with insurance companies to design policies for the clients of fielding advisors like you. So your client shouldn't have to pay more for a policy than they need to. And this is a graph that we've had for a number of years, and it just talks about the difference with a traditional low-load policy and a typical loaded policy. And within policies that have high surrender charges or things like that, there's all these other things built into it, and a low-load policy is going to have, both policies have a home office expense. If there's no one at the home office to process paperwork, can't actually have a policy. And at 10% marketing, and in the case of the low-load policies we recommend, that's really us, or for companies that allow people to go directly to them at the same time, the cost of having some of those people in home office. So let's take Jim B. He's a male, 66, standard non-smoker. He has an existing $500,000 variable UL policy. There's his cash value. And under current projections, he needs to pay $3,000 $405 to carry the policy to his age 100. So Jim is looking at, would like all three of those things. Would like to increase coverage, would like to stop premiums, would like to get out of the volatility of the variable UL policy. And at the same time, guarantee coverage for a legacy, which is his spouse first and then his children afterwards. Now, unfortunately, because the other policy was going to require premiums for all years, we can't quite get there with the amount of cash values he has. We can have no more premiums, we can have no more volatility, can't quite get the increased coverage. But when we look at Columbus Life's Low Load Advisor Plus UL, you can see how it stacks up against the competition. For the same $138,000 for a male age 66 standard non-smoker, all things being equal, that one 1035 exchange is going to offer a lot more with that low load policy than the other options that are available today. There's also a low load guaranteed survivorship UL. And another example of real clients. Mark is 56 and Robin is 53. And they need a second to die survivorship policy inside an irrevocable life insurance trust to provide funds for their children, one of whom has special needs. And they've already done some estate planning. They have some other policies that they're working around. And so our need is this kind of funny $1,819,000. And again, with the American General Low Load Advantage GSUL, it has the lowest premium of all the other options available. Now, you're probably looking at that and thinking, that's not a really huge savings. Still the lowest out there. But the difference is that the American General Low Load policy builds a growing cash value in later years in case needs change. And especially here if we have, especially for survivorship policies, when you have special needs children. In the case of Mark and Robin, life expectancy is pretty normal for the child, but when you have situations that you plan for long-term but may or may not want to, may not need to hold the policy, or parents, it's possible they outlive the need, then those cash values in the later years are valuable again. So lowest premium and cash values going forward. Somebody asked, are there any carriers? Are there any carriers that you don't offer? Sure, there's a number of different companies that we don't work with for financial, because of financial strength, their customer service. There are some that we've tried working with in the past, and just we didn't think their customer service was up to our standards, which means they definitely wouldn't be up to your standards and your client standards. So how do we put together a menu of carriers? If you go to our advisor tools on our website, there's a list of all the carriers we recommend. So in addition to financial strength, ability to work with them, and good policies, that's how we put together that menu. So the next thing I want to talk about are annuities. Arthur is 68 and Kathleen is 64, and they have a relatively simple story. They purchased an annuity to create retirement income later in life. So surprise, surprise, they purchased an annuity for the right reason, and they're retired as of January 1st, so it's income time. And they were offered a payment through their annuity, which wasn't that great, so we ran a number of different payments for them, and Integrity's single premium immediate annuity designed for fee-only RIAs has the highest payment of all. And when you, basically an annuity, when you take out a lot of the compensation and other things, it just creates a higher payment. So that's a 3.7% higher payment each month. On a fixed deferred annuity, Integrity's single premium deferred annuity has the highest rates, 18% more over 10 years compared to other options, and a lot more than a 10-year CD. Same thing with our 5-year fixed deferred, 19% more over 5 years, a lot better than a 5-year CD. Another thing we want to touch on are the death benefits on annuity. Tim C. has a $207,000 annuity. He's paid in $180,000. This annuity is inside of an IRA, so he has the tax deferral twice. His only rider is really this death benefit rider. It states the death benefit will be the greater of the annuity value at the date of death. If you die today, it's $207,000. Or the sum of premiums paid, which is $180,000, minus any withdrawals or money taken out. So what we have here is that there's only a death benefit if the annuity values drop below $180,000. But he's paying 1.4% for this rider. And today, because the annuity value is $207,000, if he dies, somebody gets $207,000. There's actually zero insurance. 100% of that is his own money. But he's 60 and he's preferred, and he needs to keep $200,000 for the rest of his life. So on that annuity, he's paying almost $2,900. He can purchase outside of the annuity a $200,000 life insurance policy for almost the same premium. So if Tim dies tomorrow with the annuity, somebody gets $207,000. If he moves that annuity into a regular IRA, there's $207,000. And if he purchases income tax-free life insurance, there's $200,000. So at the end of the day, by separating the policies, there'd be $407,000 to his heirs if he died the next day. And it really didn't cost him anything different. It's just inside the annuity, it was coming off of his earnings and yield. He didn't feel it instead of writing a check. But when you separate things out, it's going to be much more efficient. Long-term care insurance. As I said, there aren't any no-load or low-load long-term care policies. But one way we look at making sure your clients are paying for just the right amount of coverage is how much should your client have. Let's jump down to here in Tampa. The private nursing home room is $255. But what's in that $255? Of 3,800 certified and licensed nursing homes surveyed, the daily room charge usually includes services beyond rent, such as 3 meals per day. Oh, and somebody said on slide 42, you are assuming no surrender charges on the annuity to convert the annuity to an IRA. You are absolutely correct. It was past the surrender charge period. So within the long-term care, the daily room charge includes 3 meals a day, laundry, sundries, which I had to look up what exactly that means. I would think of it like at the snack bar at a hotel. But things you just sort of need, your daily necessities. Basic nurse supervision, generic non-prescription medications. So we go back to Tampa and our $255 day in a private room. Again, I'm coming back to the first 3 things. 3 meals a day, laundry, sundries. Let's look at our 80% rule. Now, how do I come up with the 80% rule? Do you expect your client to eat in retirement? I'm guessing yes. They're going to eat whether they're in a nursing home or not. They are going to do laundry whether they're in a nursing home or not. They're going to pay a cable bill, buy over-the-counter medications, whether they're in a nursing home or not. So why would they pay to buy insurance to cover an expense that they would already have in their budget and already have regardless? So let's use the long-term care insurance to cover additional living expenses, those other charges, basic nurse supervision that you don't have if you're just at home in your condo here in Florida. So let's say that 20% of the cost of care are for those essentials. And I had a relatively non-scientific sampling of a few advisors and a few of their clients, but 20% is about what we came to. So instead of $255 needing to purchase long-term care for $255 per day based on the cost of care here in Tampa, it's $200 a day. And the best part about that, it reduces the client's premiums by, you guessed it, 20%. It's proportional to the penny. So a 20% reduction in the daily benefit, all things being equal, is a 20% reduction in premiums. So Hero and Yuko have a 90-day elimination policy, 3% compound 3-year benefit with shared care. And originally we looked at $255 a day based on the cost here in Tampa. But when we explained the 80% rule and that, you know what, they are going to eat no matter what. And I sure hope they do laundry no matter where they are. Then a $200 a day benefit covers the additional fees and expenses they're going to have if they need long-term care. And the last thing we're going to touch on is disability insurance. Savings with FIOs. And what is the future increase option? This is a way for your client to purchase additional coverage on top of a base, on top of a life insurance or disability policy that they already own. It requires financial underwriting only, meaning you need to show a 1099 or W-2 to financially justify that the client qualifies for additional benefits, but it doesn't require any medical underwriting. And so this is particularly valuable for a lot of clients. Let me give you an example. Let's take Dave. I think I wrote this because that's how I talk. Let's take Dave. He's a 38-year-old software engineer, and he's in good health. And he's self-employed. He's a software engineer. He sits at a desk all day, and he's 6 foot 235. Makes $150,000 a year, and doesn't have any group disability or anything else. So his advisor, you, recommend he get a long-term disability policy. And so today, he'd be able to qualify for a 90-day elimination period, benefits to age 65, $6,900 per month, and we included the residual and future increase options, and his annual premium is going to be $2,356 per year. Now let's fast forward 3 years. Dave is now, well, he's 3 years older, and Dave has done 3 more years of sitting, and so now Dave is 6 foot and 250. But because he's been doing more sitting, he's been doing more computer stuff, and now he's making $200,000 a year. But because of his build, any new disability coverage he might purchase would have a 25% rating, meaning that he would pay an additional 25% on top of someone who would just be in the normal or standard build charts and health class. So he could purchase, he qualifies financially for another $2,250 of monthly benefits. And at age 41, because he's 3 years older, with that 25% rating, it would cost him $1,126 per year for that additional coverage. But because we have the future increase option, he purchased that on his policy when he got it 3 years ago, he can get the same $2,250 today, because we do have to have financial documentation and justification, but that's it. No medical questions. So if he can qualify for the $2,250 on one hand, he can do it on the other hand. Still age 41, because he's 3 years older. There's nothing we can do about time, but because there are no health questions, that same $2,250 would be $901 without the rating. Remember, there's no medical questions, no nothing. He's still, as far as medically, he's just, Dave from 3 years ago. So that saves him $225 per year. Why $225? Well, if he qualified, needed to qualify today, he'd have the 25% rating, and that would be $1,126 a year. With the future increase option, the same coverage is $901. So a savings of $225 per year. Now, fast forward to age 65, that's $5,400 per year. Good question. I had somebody ask, how much is FIO? Some companies include the future increase options, benefit updates on a policy for actually no additional premium. You still must qualify, and if Dave had been rated originally, he may not be able to get it on the policy. Other companies, it's a pretty nominal charge to have that on the policy today. Remember, it's not a free increase because, as you see here, when Dave wants to increase it, he's still purchasing additional coverage based on his age 41, based on the $2,250, but doesn't cost very much to have that guaranteed increase option on the policy, if anything at all. And the last thing we're going to talk about, what about lifetime benefits on my disability policy? And this is one of those things that just sounds great, kind of like the undercoating on a car. You know, somebody tells you about the rust, and here in Florida it's the salt water. I'm sure for you all it's, many of you, it's salt and snow and all kinds of stuff. But it sounds great. If I become disabled and I'm disabled, then my policy will pay me for you know, a long time, pay for as long as I live. You know, again, just sounds great. And it can be, but it's sort of sort of. This is true with most companies. Most of the companies, it's called a graded lifetime benefit. Many times you don't hear the word graded, or it's kind of mumbled like lifetime benefit. It's true if someone becomes disabled on or before age 45, and again, I'm speaking in general terms here. Each company is different, but they're more often more similar than they are different. It's true if I become disabled on or before age 45 and I remain totally disabled to age 65. And then benefits continue for life. And if it's before age 45, this is true. The same benefits continue for life. But between age 45 and 65, it's a sliding scale. So every year that a client becomes disabled between 45 and 65, it reduces the lifetime benefit by an additional, by 5%. So you can see that right here. Let's say a client becomes disabled at age 55. Their marker is 50%. So a client would receive the full benefit to age 65, and then after age 65, he or she would get 50% of the benefit after age 65. Complicated? I agree. Put it another way. Joe has a disability policy with this graded lifetime benefit on it, and it has $8,000 of monthly benefits with the graded lifetime rider. He becomes diagnosed with MS at age 58 and becomes disabled. So he still receives the $8,000 per month to age 65. To age 65, the benefit's full. And then the lifetime benefit part kicks in. So because he was diagnosed here at age 58, after age 65, we go right up here to this 35%. So $8,000 a month to age 65. Nothing happens before age 65, full benefits. At age 66, he will still continue to receive benefits of $2,800 per month, 35% of that original $8,000. So is it better than a stick in the eye? Well, of course. I mean, it's a nice thing. If somebody happened to become disabled before age 45, you know, it would have been something really great to have. But like all things insurance, I'm sure your clients don't want to pay for every conceivable insurance rider that's out there. I know I don't, and I'm an insurance person. So is it worth an additional approximately 33% each year to have this this extra disability? You know, if I happen to become disabled at these points of time, and then be continuously disabled at age 65. Sort of there's a caveat to it, and so to pay an extra 33%, to me, it's not worth it. I have 2 disability policies. Neither one of them have a lifetime benefit rider on. So if that means anything, I didn't think it was worth the additional premium. So we covered a number of different things, sort of a whole color spectrum here. So did you know that our 2014 first quarter Policy Matters e-newsletter went out this morning? That's really hard to say. So are you in our database? I've had a number of you already email me back that you saw some great pictures of me at our academy that we just hosted. If for any of those who weren't there and want to look at the pictures, yes, I am wearing a white tux with tails. I've tried to get Low Load Insurance Services to go business casual Fridays and black tie only on Thursdays, but so far nobody's buying that. We can help your business owner clients save on group disability, and we just finished our annual LLIS Insurance Academy. Thank you to all of you who attended. I think we had 52. To the few of you who got snowed in, sure hope you can make it next year. So for those of you who may be new to low-load insurance services, we came up with 10 things that make us different than anybody else out there. The first thing we do are free monthly webinars. This year we're doing insurance by the numbers, so we go from 0 to 10. We skip January. This month, February is 0, so we get to 10 in December with 1035 exchanges. But next month in March, we're going to, Kathy Kopak will talk about disability and how 1 in 4 of today's 20-year-olds become disabled before they retire. Other things. We are not your competition. Our only clients are fee-only financial advisors. So everything we do is to save you time, to save your clients money, and we do pre-underwriting to avoid surprises and to make you all look good. We are proud sponsors of a number of financial planning groups, NAPFA, ACA, Garrett Planning Network, and we're the national sponsor of the NAPFA Genesis group, younger financial planners. We have product specialists in life, disability, long-term care, and annuities. Jerry Skapiak is our annuity guru. Next month you'll hear about disability from Kathy Kopak. When your clients get insurance through us, we keep you in the loop with our AIM system, our application information message. Another hard one to say. So as a client's application is going through the process, you're kept in the loop when they've submitted their paperwork, when they've been approved. So there's not a black hole that when you refer your clients to us, you never hear from them again. And a lot of insurance people out there might be here today and gone tomorrow. We manage your clients' policies both now and in the future. Our APE, our Advanced Premium email, lets you and your clients know that a premium is coming due, so to look out for it so that they don't lapse accidentally. Our note system follows the policy for the full 10, 15, 20, or even 30 years of the contract and lets you and your client know when they're coming to the end of the term period and need to make a decision about whether to apply for new coverage, convert the policy to another form of life insurance, and what options might be available at that point. So I have a number of questions here that came over online, so I'm going to start talking about those. One of the questions is, what COLA rate do you typically recommend on a long-term care policy? That's a good question. The majority of states have guidelines on what makes a policy eligible for the long-term care partnership program. For those of you who may not know, the long-term care partnership program states that if a policy qualifies, you can access your long-term care policy, and benefits received go against your create a asset look back if your client ever needs to go on Medicaid. In most states, and I forget the numbers right now, but some form of compounded inflation option for younger clients as they get older may not need the compound inflation, but may require some sort of automatic, like a 5% simple. For younger clients, 5% compound is probably still the one that's going to, the last number I saw was that over the last 5 years, costs for all things long-term care-ish have gone up about 4.45% on a 5-year average. So the 5% compound is going to be the most comprehensive. 3% compound, most insurance companies have added that as an option, and tends to have a lower premium. So for clients who may be in the ability to do a little more self-insuring rather than the 5% compound, it's a nice option. Another question we have is, do you tend to recommend the FIO rather than the COLA? There's a lot of FIO is the future increase option on a disability policy, and the COLA is the cost of living adjustment on a disability policy. I actually have both on my policies because they do two different things. The future increase option allows me to, as time goes on, if I'm making more money, I can increase my benefit when I'm not on claim. So I start at a higher dollar amount. The COLA works on the back end that says if I become disabled, then after 12 months of being on disability, I start receiving my benefits, and then the premiums adjust or increase as I'm receiving them every 12 months by some factor. They do two different things. FIO lets me purchase it up front so that I start off higher. With the COLA, it grows in the future. So, like I said, I have both. If I had if I had to pick one for cost, I would go with the future increase option, just because that way I know I'd start off at a higher amount initially. Majority of claims can be long, but may not be decades long. So to start off at a higher number rather than have an increase in number in the future would probably be my how I'd look at it. Somebody asked a question about all the riders, and I say, I presume these are things you look for, but not wholesale to all cases, carriers, and policies, and would still suggest a review of each rider, client by client, policy by policy. Absolutely. Let's say we have a client who has a waiver of premium rider on a policy, and we know he's had a heart attack or been diagnosed with cancer, or maybe is starting some signs of forgetfulness, hasn't been diagnosed with dementia yet, but all kinds of things that make these things that for X person, it's probably not worth it, better to get an individual disability policy. But if the same person can't qualify for an individual policy, then the waiver of premium rider is good. So yes, absolutely, this is a step-by-step, person-by-person, case-by-case. Please don't look at all of your clients' policies and just tell every one of them to cancel the waiver of premium rider right now because I said so. It is definitely an individual consideration. So thank you for that. Okay, if there are any other questions, I have a few other that are either a little too complicated for me to get into in the next 60 seconds, or relatively individualized that I'd be happy to follow up with you offline. So if there aren't any other questions, thank you all very much for attending. This was a great showing. Great number of people showed up. So, and if any of you were at the Academy last week, again, thank you for coming to that. It's always great to see all these names here of people I recognize, and I hope that everybody has a nice day and tunes back in March for the 1 in 4 people, the chances of 1 in 4 being disabled, and Kathy Kopak will talk about disability. So thank you very much. Bye.